Welcome to Trade with Sagar Patel. Here, we bring you deep market insights, expert strategies, and practical knowledge to help you navigate the stock market with confidence. Whether you're a trader, long-term investor, or just getting started, our goal is to equip you with the right mindset and approach to make informed financial decisions. Lately, I've noticed a recurring pattern in the comments section of our videos. This pattern reflects the mindset of most retail investors and traders, giving us a glimpse into the common thought process in the stock market. However, there's an important rule in investing. When too many people start thinking in the same direction, the probability of being wrong increases significantly. And in the stock market, being wrong doesn't just mean a difference of opinion, it means financial loss. This is exactly why the majority of retail investors often find themselves on the losing side, while a small group of smart players profit from their mistakes. What we'll cover today: why do 99% of investors and traders fall into the same trap? How does their decision-making process go wrong? Most importantly, who actually benefits from these mistakes? Many of you already understand that stock market movements are not random. They are influenced by powerful market operators. These operators know exactly where the crowd is heading, and they use this knowledge to their advantage. They understand mass psychology and take actions that go against the majority sentiment, making retail investors fall into their traps over and over again. Now, before we dive deeper, I want to clarify something. If you are a long-term investor, this discussion is especially relevant for you. Trading and long-term investing operate on entirely different principles. Just like a T20 match and a test match require completely different strategies, the same applies to the stock market. If you apply short-term trading principles to long-term investing, you are bound to make mistakes. The illusion of market news. Every day, the market is flooded with news, some good, some bad. If a company belongs to the pharma sector, any regulatory changes or drug approvals affect its stock. If it's an auto company, policy changes, sales numbers, or raw material costs play a role. Similarly, banking, finance, aviation, and energy stocks react to sector-specific updates. Now, let's say negative news comes out about a company. It could be anything: a financial setback, regulatory action, or a major business loss. Most retail investors assume that since the news is bad, the stock price should fall. But what happens next? The next trading day, the stock price actually rises. This is where confusion sets in. Retail investors start questioning their own judgment. If the news was negative, why is the stock going up? This doubt leads to hesitation, and hesitation leads to emotional decision-making. Now, let's pause for a moment and analyze this situation logically. When you first read the news, you made a rational decision. You understood that the news was negative, and your analysis told you that the stock should fall. But when the stock price moved in the opposite direction, doubt overpowered your logic. And this is where 99% of people make the mistake. They stop trusting their own analysis and start reacting to short-term price movements instead. This is exactly what market operators want. Understanding the trap. The stock market is driven by a cycle of emotions, fear, and greed. Operators know that when negative news spreads, retail investors will panic and sell their shares. But instead of the stock falling further, it starts rising because these very operators are buying at lower prices. They create artificial demand, triggering FOMO, fear of missing out, among investors who initially sold in panic. The same trick works in reverse as well. Sometimes, extremely positive news comes out about a company, and everyone expects the stock to shoot up. But what happens? The stock starts falling instead. This is a classic case of smart money exiting, while retail investors rush to buy, thinking they are making the right move. But in reality, they are stepping into a trap. Real-world examples. This has happened countless times in the past. Think about stocks like Yes Bank and DHFL. Many investors got stuck at high prices because they followed short-term price trends instead of fundamental analysis. At one point, Yes Bank was trading at 400 to 500, and retail investors kept buying, believing that the stock would only go higher. But those who ignored warning signs ended up facing massive losses when the stock crashed. This is why it's crucial to separate hype from reality. Just because a stock is rising doesn't mean it is fundamentally strong, and just because a stock is falling doesn't mean it's fundamentally weak. Operators play these psychological games daily, and unless you learn to recognize their tactics, you will continue falling into the same trap. The key takeaway: the biggest lesson here is to develop independent thinking. Stop following the crowd. If everyone around you is talking about the same stock, take a step back and analyze whether the excitement is justified or if it's just another market trap. Learn to differentiate between real value and manipulated price movements. At the end of the day, the stock market is not just about numbers, it's about psychology. And those who understand it will always have the upper hand. Final thoughts. At Trade with Sagar Patel, our mission is to help you break free from the common retail investor mindset and equip you with the tools needed for smart trading and investing. If you found this video insightful, make sure to like, share, and subscribe to stay updated with more valuable content. Let me know your thoughts in the comments. Have you ever experienced these market traps? How did you handle them? Let's discuss and grow together. See you in the next video. Until then, trade smart, stay informed, and keep learning. This got it.